people are kind of duped into thinking that they're saving for retirement, but really what they're doing is they're investing for retirement. And we live in this world where over 70% of the money that's saved in this country isn't really saved, it's invested, and it's in high risk accounts with qualified accounts in IRAs and 401ks that the government has control of. So not only are they in risk from market risk, but they're in risk for taxation risk in a world that, the government is out of control with their spending. The government is, it has the ability to tax your money away from you with their bad decisions, with their irresponsible behavior. They don't have a lot of accountability, right? I think we can all agree that politicians aren't the best money managers in the world. Our government is not the best money manager in the world. If we all managed our personal household finances or our business finances like the government managed theirs, we'd all be out of business. We'd be bankrupt, right? Hey, what's going on, cash flow hackers? It is Chris with Life 180. And for this video, I want to talk to you about the 5 things that you need to do to become wealthy. Now, this is going to be a little different than a lot of the other videos that focus in this area. But ultimately, if you want to become wealthy faster, there are certain principles that you need to implement in your life, and I'm going to go through them right now. So let's get started with number 1. Really simple. Wealthy people understand this. Avoid toxic debt. One of the biggest crippling components to kind of middle America's financial world right now is they're just burdened by crazy amounts of high interest toxic debt. It kills their cash flow. It just puts a lot of stress on your financial positioning. It makes it so you're not open to be able to take advantage of opportunities. Typically, it hurts your credit, which hurts opportunity, in times that you need it. And so I'm not going to spend a lot of time on this. This is a pretty simple one, but I'm telling you, number 1, the principle: avoid toxic debt. If you have any debt, credit card debt, high interest car or auto debt, any auto debt that's over 4.5%, 5%, get rid of it. Like, work on trying to get rid of that as soon as possible. And then, that's it. Like, when you can clean up that debt, then you can work on trying to save for your future. I see too many people who are trying to save for their future, who are, putting money into a 401k or saving money for a rainy day. And I know you need to have a little money set aside, and I get that, but people are trying to make 6% to 8% on their investments, and meanwhile they got $20,000 in credit card debt or $10,000 in credit card debt where they're paying 18 to 20% on it, right? It just doesn't make any sense from a long-term wealth potential perspective. From a cash flow perspective, I'd rather see you pay off the 18% credit card debt for $10,000, free up that cash flow, and then be smart with the freed up cash flow, because this is all about cash flow, right? So if you can reallocate the cash flow that you freed up and then save that or invest it after the fact, you're going to be so much better served. So that's number 1. So number 2, the second thing you need to do is minimize your expenses. I always kind of tell people Life 180 is an acronym for living intentionally for excellence, right? Like, so we have to be intentional about our spending, period, right? I always kind of say, if you handle your personal finances like you handle a business's finances, you're going to be much better served. Running accounts, like having a QuickBooks account or a Quicken account, or even using something as simple as Mint to kind of manage your personal finances and making sure that you're looking at it, making sure that your expenses, your inflow, your revenue, your income, whatever that is, think about your income as business revenue. Think about your outflows, your expenses as overhead, right? For running the business. If you want to get ahead, you need to make sure that your expenses are managed, they're minimized, they're intentional. Too many people, they have apps for this now that go through and will check, like, what do you have on auto subscription, money that's coming out of your account every month. And when you look at how much money you're wasting and you're spending unknowingly, unnecessarily, and what that opportunity cost is for the money that you're giving up control of, it's astounding. And I see it over and over and over. I talk to people all the time. We've been able to find multiple thousands of dollars every single month for people, Usually, I guess that's a pretty extreme example for people that are doing really well. But literally, it's not hard to find a couple $1,000s a year. So in most people's situation, think about it. If you're making $50,000 a year and you could find $2,000 a year in unnecessary expenses, that's the equivalent of a 4% return on a $50,000 investment with no risk, right? Like, so think about that. It's a really, really powerful thing to think about is just the financial efficiency, being intentional with your expenses, thinking about running your personal finances like a business, and you're going to be better served. So the third thing is actually something I'm pretty passionate about. And this is a concept that I think eludes a lot of people. And the concept is you need to save before you invest. And I talk a lot about this in my financial pyramid video, which is basically what's taught in the CFP course, teaching people how to save money, how to design and structure your financial life. And if you look at your life like a pyramid, and you can check out the link above if you want to go watch the video in full on the Life 180 financial pyramid. But if you look at it, it's basically saying the foundation of your pyramid needs to be built. It needs to be built on like a foundation of stone. And that foundation has to be built with savings and protection to make sure that no matter what happens on the top of the pyramid with other investments, when you have downswings in the market, whether you have investments that crash on you or whatever, because of that foundation being there, if there's an economic downswing or if you made a bad financial choice or if you invested in the wrong area, it's not going to cripple your financial life. And that's the biggest problem that we see in this world is people are kind of duped into thinking that they're saving for retirement, but really what they're doing is they're investing for retirement. And we live in this world where over 70% of the money that's saved in this country isn't really saved, it's invested, and it's in high risk accounts with qualified accounts in IRAs and 401ks that the government has control of. So not only are they in risk from market risk, but they're in risk for taxation risk in a world that, the government is out of control with their spending. The government is, it has the ability to tax your money away from you with their bad decisions, with their irresponsible behavior. They don't have a lot of accountability, right? I think we can all agree that politicians aren't the best money managers in the world. Our government is not the best money manager in the world. If we all managed our personal household finances or our business finances like the government managed theirs, we'd all be out of business. We'd be bankrupt, right? But they have the ability to tap into the Fed, to print money, kind of have a blank check on what they want to do. But the problem is at some point in time that has to get paid for. So if you're 50, 55 and under, and you're worried about this, in the next decade, this is going to become a problem. They're going to have to start raising tax revenues from somewhere. My guess is going to come from qualified accounts. And so here's where I'm going with this. If you put money into these accounts that you don't have access to and you're risking money on, it puts you at risk during the downward cycles because we live in a cyclical economy, right? It goes up, it comes down, it goes up, it comes down. It's when it comes down that you want to take advantage of the opportunities. So saving your money, the difference between saving and investing is just a function of risk. And investing, comes with risk. Savings comes with no risk. The problem is so many people are investing in when they think they're saving right now because of the fact that most people think you can't save and get any kind of rate of return. And the reality is that's not the case.
You keep using the word. I don't think it means what you think it means.
But I got a lot of videos on that. But the concept here, number 3, is that you need to save before you invest. And I'm a big believer that you need to save at least a year of income before you start to invest. You need to have a year of income completely liquid, accessible, in your control, in an account that's guaranteed not to lose when the economy goes down. And I'll say this principle never changes, quite frankly, it just never changes. However, the biggest thing I could say right now is it's more important at this very moment. We're in to a 12-year bull run, right? Like we're a bull cycle here that 12 years the market's been going up effectively without any pullback, at least over a year period of time. All right, so the biggest thing that I can say is like right now we're 12 years into a bull run, a bull cycle in the economy, and having that year liquidity in an account that will not lose is going to open yourself up to a lot of opportunity. Saving before investing is so important. The biggest lie that people are told is the younger you are, the more risk you can take. Only in the financial world do we tell people that you increase your chance of success and achieving what you want by increasing your chance of loss, because that's all risk is. That's all investments are. That's why my passion is to teach people how to operate your finances more efficiently. And when you do that and you understand the cycles of things, and that's why you need to watch the financial pyramid video that I talk about, it will make a lot of sense to you. And I think it'll encourage you to make some changes in the way that you design your financial structure in your personal life. And that goes back to number 2, operating your personal life more like a business. than how most people are doing it in this country. So number 4 is investing in cash flow assets, right? So it's no surprise if you've watched this channel and you've been watching me, and any of the content that we create on this channel, we're not big believers in investing in mutual funds and buying and holding assets and putting your money into accounts that you have no access to, that you can't control, that you're exposed to all these different risks that are outside of your control, all to hope that it's going to grow and be accessible and have enough money in accumulation and get the returns that you're hoping for at some date far off into the future when we don't even know what the world is going to look like, right? So how can you plan for something if you don't know the variables that go into what you need to plan for? You don't know what inflation is going to look like. You don't know what the average return in the economy is going to look like. You don't know what the tax environment is going to look like. And quite frankly, you don't know what the economy is going to look like. You don't know what your ability to save is going to look like. You don't know how much risk and how many cycles we're going to kind of go through. And if you don't prepare for the things that are short term, then it's, you're setting yourself up to fail. Ultimately, your people plan for way too far out with way too little clarity, and that in turn forces them to take on far too much risk, right? So what I tell people is invest in cash flow assets, because you can control the results of cash flow assets on much more of a short-term basis. And when you do that, not only are you increasing your cash flow, but if you invest in the right cash flow assets, you're going to get cash flow from it. But the appreciation of those assets is also going to go up. They're going to go up in value. So it kind of functions as an inflation hedge, and you get the cash flow. So it can increase your net wealth, it can increase your cash flow. So it's kind of a win-win situation. And honestly, it's going to put you in a much better situation where you're more in control of the results in your life. And I think that's a big component of what separates people who are successful with their planning versus people who are unsuccessful with their planning. And finally, the 5th thing that you need to do to become wealthy, if you want to have the fast track, is you need to invest in yourself and invest in your potential earning power, right? Your ability to create revenue, to create income is the number one need that you have in your life. I talk to too many people who are concerned and scrimping and scraping by, who, maybe make $80,000 to $100,000 a year as a household between a husband and a wife. And they got kids, they have bills. And after, the month, the old phrase, they have more month than money, going on, right? And so the bottom line is they get to the end of the month and they don't have enough money left. They're barely have enough to make sure all their bills are paid and all that stuff. So the number one thing that they can do is make sure that they're investing in themselves and they're increasing their earning capacity. Maybe it's a side hustle. Maybe you're increasing your skills. Maybe you, are finding another way to create revenue in your life. But the bottom line is, for most people, if you could just come up with a way to create an extra $5,000 to $10,000 a year, I promise you, if you make $100,000 a year as a couple, it's easier for you two to get together and create an extra $10,000 a year with pretty marginal effort than it is to go out and try to get a 10% rate of return on investments, right? And if you could take that extra $10,000 and put it into an asset, right, and compound that asset at a smaller rate of return, right, with no risk, that's going to get you where you want to go faster, more predictably. It's going to have you more protected. You're going to have liquidity, use, and control of that money. You're going to, when the next downward cycle happens, you're not going to be scared of it. You're going to be looking actually kind of eagerly in anticipation of it, because it's going to open up opportunity for you, because you're going to be prepared for it. And when, like Warren Buffett says, you got to make money when there's blood in the streets. You make money in the down cycles. There's no question that in 2009, more millionaires were made than ever before. At the beginning of COVID, when the market crashed, it's not a coincidence that the richest people in the world got richer, that the gap between the wealthy and the middle class got bigger and, wider, right? This is happening because people understand, the wealthy people of the world understand that you make money during times of hardship, because in those times of hardship, the middle class, the people who are not prepared for it, have to make poor financial decisions, right? When they have to make, when a big group of people has to make poor financial decisions just to survive, it creates opportunity. We have a deflationary environment where assets are cheaper, businesses are cheaper, real estate is cheaper. Like, all these things, well, maybe not real estate and COVID, because none of that makes sense with all the money printing and all the things that happened with the supply demand issues in COVID. So real estate may be the exception to the rule in that scenario, but businesses, all that stuff. I know a lot of restaurants that went down in value, right? That now the economy is opening back up. If you had the capital, you could get a lot of opportunity with certain businesses that were hit by COVID, where people had to sell just to survive. And now you can come in and take advantage of that and buy those. And now you have a great asset at a discounted price that's going to perform better moving into the future. So those are the 5 things that if you want to become wealthy and kind of find the fast track to wealth, you need to do those 5 things. Consider them not necessarily in the order that I talked about them, but those are principles that you need to implement, that you need to think about. And I would really encourage you, to start executing on them as quickly as possible. So if you have any questions, go ahead and leave it in the comment section below. If you haven't already, make sure you subscribe, hit that bell. That way you get notified every single time we launch a new video. And, like it, get this video out to more people, smash that like button, help the channel out. If you find value in this channel, there's nothing more that you could do to help the channel out, to get this more, support the channel, than hitting the like button. The YouTube algorithm loves that, and I would be honored if you did that, if you did find value in this. But that's it. Until next video, I hope you have a blessed, inspirational day, and we'll talk soon. See ya.